Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thanks, Jim. Happy snowy day in Ontario.
And just a cloudy day in Vancouver and about 8 degrees.
Oh, well, we've got full Christmas mode going here. It's lots of white, fluffy stuff.
Vancouver only gets a white Christmas 1 out of 9 years.
There you go.
I know that stat well. Danielle, both in Vancouver and Toronto, sticker shock when it comes to property taxes. Vancouver Council wants to charge homeowners 8.2% more, businesses over 9% more, plus a big hike in utility, water, and sewer fees. Toronto, what kind of tax hikes are you looking at there?
Yeah, so the Tory, John Tory, the mayor, has proposed, so they started with this designated property tax, which was 0.5% originally when it began, and now it was supposed to increase by 0.5% a year, but now it's increasing by 1.5% a year, and they want to have it be a 10.5% tax within the next 5 years. So this is something that we've been talking about for a while now, Jim, just the inevitability of the fact that they have to get money from somewhere because everything is underfunded and we're facing a massive infrastructure investment to upgrade to 21st century technology and standards. So this is water, this is energy, this is sewer, it's smart grid, it's all of it. It's 5G, the whole thing. So we've got a ton of things that need investment, and we have very limited funds have been set aside. So they can't, the hollowing out of the middle class has been an epidemic the past 10 years, the past 20 years. So there's been stagnant wages. We know we've got a debt epidemic plaguing the population in general. And so they literally can't get blood out of stones. And the only place they can look to is those who own property and corporations who have really had a hell of a good run here with, falling tax rates for many years. Well, that pendulum cannot go only in one direction. And when you have the kind of deficits that we have all over the place now, you have to find ways to increase revenue. And that's exactly what governments at every level are increasingly doing. Again, people have liked rising prices when they're property owners. The people trying to get into the property market have had a hell of a time trying to get into property markets, have taken on this massive debt burden in order to get into those property markets. But something like $1.5 trillion now outstanding in mortgage debt in Canada, of the $2.2 trillion household debt. So it's just that the numbers are all offside, and then as I say, the people owning the property, and don't get me wrong, I own property, I've seen this appreciation in my own balance sheet as a result of this over the past, say, decade in particular, but the rubber hits the road when you realize it's not a free ride, right? Because of these shortages, because of the strains, you have to expect that we're going to face higher costs, and that's going to be for utilities as well. I noticed that my recent, natural gas bill was broken down into many different constituents, showing me that delivery was part of it, but also, investment fund, carbon tax. These are all layers of fees now, which are going to flow to property owners. And I think we have to expect that because they're just, all these years of putting IOUs in the drawer, of misusing cash, of not investing long term, of being preoccupied with instant gratification on issues of, that were popular, on share buybacks at companies, all these things that have really done everything to sort of accelerate in the short term the appearance of wealth and prosperity, but at the expense of long-term strength and stability. And that's why we now are going to have a lot of strain. It's evident everywhere. The insolvency rate, which again we've touched on in the past, is leaping in Canada. Month after month, it's at a record clip. And indeed, you're starting to see in the bank earnings this week, Jim, the write-offs are now finally beginning to accelerate. They weren't raising the bad loan provisions for the expectations of these insolvencies and debt that couldn't be paid back because too much was extended. So in the latest earnings reports this week, which is the final quarter of the year for the Canadian banks, because their year ends like October 31st, you see that profits were reduced. CIBC down 6%, TD profits down 4%, Royal Bank down, RBC profits down 12%. BMO has announced they're cutting 5% of their staff. Something like 1,500 people in Canada are going to be losing their jobs. So this is part and parcel of the fact that they've all now had to, because of these escalating insolvencies and the fact they're writing down debts and reorganizing with the trustees in insolvency, they're contacting them saying, hey, these customers have way too much debt, can't repay it. You're going to have to take a lesser sum over a longer payback period. So indeed, they've been doing things like increasing their credit loss provisions. This quarter, they increased 52%, 44%, 33%. This is the start of a trend to reconnect the reality that all this debt has been too much, and that the weight of it is now, not only crushing the household, but slowing the economy. And so there is no free lunch, I think, is the bottom line. And now we're going to see that the payback phase is actually quite painful.
I'm wondering, with the banks suffering as well, is Toronto finally feeling the effects of the downturn in the Alberta oil patch, which provides so much cash for the Canadian economy overall?
Well, the service sector certainly, the finance, legal, accounting, work that was coming out of the oil and gas industry, typically into the peak in 2011, that would have been the largest impact or the largest benefit to fees. They've been declining now for the past several years. Indeed, it was interesting to see that RBC noted their downturn in earnings was partly to do with the fact that companies are not seeking funding in the public markets to the extent that they were, and that is again tied to the downturn in the energy patch and the initial public offerings. Also, the fact that the equity markets have become so contrived, so broken, so manipulated. They have really lost the confidence of any value investors. So companies are having to turn to private equity and pensions to try and price any capital raises that they're needing to do. So these are all, again, this has been a long run in the last 10 years, but it was always by adding debt and increasing the multiples. Not increasing the revenue, not increasing the investment thesis, increasing the multiple that people were prepared to pay for cash flow. And I think that's why this is going to come back to haunt people, because it hasn't been an intelligent exercise based on, how do we build strength in the future? How do we grow the business? And again, it was interesting that Mark Carney, who was, of course, our ex-Bank of Canada CEO and went to head up the Bank of England the past many years, his job is up January. He's time to move to a new position, and he's taken on a UN Special Envoy, which, on the Financial Stability Board, the International Financial Stability Board, he did a lot of work in the last few years on encouraging more accurate financial disclosure for corporations around their climate risks. So this is specifically financial companies, accounting firms. This is not just energy companies, but all companies that are facing, increased insurance costs, increased catastrophic loss costs, and impacts on their business, which are negative in this very volatile environment that we now have. Whatever you believe about the causes, the reality is that it is a much more volatile climate, and that's having a lot of costs. So the push has been on, to say, look, companies, you're not pricing this correctly. You have to start having disclosure of the costs and impacts that you're facing, the reduction in revenue in many areas that you're going to face, the increased costs that you're going to bear, the full cost accounting that we're going to insist that you do now. All these things are really very relevant to every sector, and especially in the Canadian economy. So he made a quote in one of his talks just saying, and this is something where I've said several times, we have to focus on, that good old hockey analogy. We have to focus on where the puck's going next, right? And he said, literally, we have to move capital from where it is today to where it needs to be tomorrow. And companies that don't adapt, and that includes financial services companies who have been, underwriting investment in this area and all that, will definitely go bankrupt if we don't make this adjustment. He said, without question, the companies will go bankrupt. So although that's a very unpopular message, and although no one wants to see increased funding or increased taxes required, that is going to be essential in this transition. We've really plugged our ears and hummed long enough, and we've avoided the reality of our situation, and now we must evolve. It's adapt or die.
Shell Oil a few years ago bought a $200 million wind farm in Europe. Is that a thing that oil companies are going to have to do in the future?
Well, if they have to decide if they want to be energy companies or not. And if they want to be energy companies, they have to take a broader scope of what that means. I think it was also Shell who wants to build out the infrastructure they want to have EV charging stations now at all of their gas stations. I saw a stat this week that was very interesting. It says that the cost of the Trans-Canada pipeline, 1/10 of that cost would be what's required to build out charging stations across the country. And indeed, we could do it at places that are either existing gas stations and or buildings like the post office, as an example. So just taking infrastructure that's already there and putting these charging stations. Anyway, the thing is, you can pretend or insist that you don't want this change, but this change is happening. And back to Mark Carney's point, we have to get a lot smarter. You see, for example, it's sort of like the same issue everywhere you look at the moment. You see the largest protests of ever in France right now, right? There's some 500,000 people demonstrating in 40 cities. Why? Because of pension reform that's been proposed in France. So you've got a nationwide strike, police, lawyers, hospital staff, airport workers, everyone. They've shut down 90% of the high-speed trains in the inner city and hundreds of flight cancellations. Why? Because the government is having to reorganize the pension plans because they have not been funded properly. They have been doubling down on risk and hoping it would work out and not actually serving the end purpose which people were expecting. And unrealistic expectations have been the scourge of the earth in the last decade or so. People have expected to retire at 50. This is classic, right? We've got a whole bunch of Canadians who think they should be retired at 50 or 55. And when you look at the math of what they have in terms of money, when you look at the pension funding ratios, the reality is that there isn't the money there. So it is not realistic to think that you're going to be able to stop work in your 50s, live to your 90s, and it's all going to work out. So we've got a very messy period here where, again, the window dressing, the glossing over, that period is behind us. Now we have the hard work of actually making equations balance again, investing for medium and long-term goals again, raising funds for purpose-driven needs, this sort of thing, instead of financial gimmicks. It's very critical. Another thing that's very interesting this week, if it's kind of on this theme, is the Aramco IPO. I don't know if you saw that, Jim, but it's finally, they've been talking about, this is a Saudi Arabia's oil company, which is, massive, and it's called Aramco, and they had been talking for the past couple of years about wanting to sell off a portion of it to private investors to raise cash. because they too have a very undiversified economy, worse than Canada, but same kind of, they had the preoccupation with the oil, which was their main source of everything, all their revenue, everything built around that, and they really didn't plan properly for diversifying the economy for the future. And now, they were hoping to sell, at one point they were talking about selling off 3 to 5% of their shares in that company, and they've now priced, they're only going to be able to sell about 1.5 shares. This is the initial float that they've priced today, and it's going to come out at about up $8.53 a share for the largest IPO ever. $25 billion, which is slightly bigger than the Alibaba one in China, which was the biggest at the time. But the point is that they've valued this company something like $1.5 trillion based on the presumption of, growing demand for their product. And that is really up in the air. It's very questionable. You have a lot of investors, institutions not even interested in this IPO because of all the concerns and all the costs mounting in that sector. So now we've got, the buyers of this particular IPO are largely domestic and regional individuals, middle class and less people who are being urged to buy shares in this company so that they can cash out, this $25 billion and then try and divert it into investment in other areas to build up their economy. But the problem is, just like all IPOs, the largest share of them are priced too high, and this one is. And what happens is people either, in this case or in some cases here, they're forced to buy these shares through leverage that Saudi Arabia is holding over them. But, they buy the IPO, it falls in value, they lose their savings, and, they're even worse off then. So it's just the same, trying to sell the old product, the old ideas, the old approaches. We really have to think fresh and start over.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Danielle Park. Danielle, the Bank of Canada kept its trend-setting rate the same the last time they made their announcement this week. What does that tell us about the state of the economy or Canadian debt, things like that?
Yeah, well, I say they're stuck in a catch-22 because, as you know, the Bank of Canada is at their policy rate is at 1.75 today. Having ratcheted it up, they've now had 9 consecutive meetings of not doing anything. Even while the world has slowed, the global economy has slowed, they've brought down their expectations for growth for the Canadian economy. They're now forecasting a 1.3% growth rate in the second half of 2019, and they hope for about 1.7 next year. And of course, if there's a recession in the cards here, all bets are off in terms of those even modest growth rates. So they're, on the one hand, they look at the record debt in the Canadian economy, the vulnerability, the spiking insolvencies that are already hitting banks, and this is all before we even get into any major job losses, Jim. We're sort of near peak employment right now in the economy, and rates are still historically at the very low end, and still we're having all these people that finally give up and say we can't pay these bills. So they're between this very, difficult choice. On the one hand, they've got, the highest policy rate now of G7 and Australia and New Zealand, 1.75 is the highest, of that whole peer group. So while they're looking at a slowing economy, and while they realize that we're overdue for a recession, they don't want to blow their budget, so to speak. They want to retain some stimulative ability. Remember, they normally come into downturns with 5% plus of room in terms of stimulus to cut and offer credit to the economy. This time they've already got record credit, and 1.75 is the maximum amount of rate they have to tinker with on the short end. And so they're really trying to have a brave face and not blow that too early and wait for, the things to get much worse before they start spending whatever they've got left. But on the other hand, because they have this strong policy rate, the Canadian currency has held up better than its counterparts against the U.S. dollar. We're slightly positive, about 3% over the past year, that the loonies appreciate against the U.S. dollar. And we're an export-dependent economy, as you know, especially with our domestic economy being, vulnerable, weak, not very well diversified, not firing on all cylinders at this point. So on the one hand, they want a weaker currency. They'd like to see a weaker currency. They'd like to see stronger exports. But on the other hand, they're terrified that if they lower rates anymore, they're going to have an even larger debt bubble on their hands in the domestic economy. And this is, even by holding rates, this shows you how interconnected all this is. Even by holding rates steady over the past 9 meetings, what's happened is because the global economy has turned down, the bond markets of the world have been bid. So treasury markets. So the 5-year government bond in Canada, for example, which is the benchmark for mortgage rates, has been bid by capital coming in, attracted by marginally higher rates here than in other countries. And that's helped to push up the value of our currency. It has helped to push up the price of our treasuries and push down interest rates. And so even though they didn't want to lower interest rates in this environment with the domestic economy as it is, that has been the effect. And indeed, although, back in 2017 when we were talking about, the higher borrowing rates that came in because they had hiked rates for a while, and because they'd brought in the speculation tax, and because they'd had more stringent lending standards for first-time home buyers and all that good stuff, you did start to see a downturn in housing costs in Canada. In 2017, they began to roll over. That was going in the right direction, right? It was starting to become somewhat more affordable. We're still extremely unaffordable, but somewhat more affordable. And indeed, we saw mortgage debt start to turn down as well because, people weren't in the bidding wars buying whatever and taking on, debt without any thought. And so it started to go the right way, but the problem is that since rates have rolled over again from these international factors which have buoyed our bond market and taken our yields down and reduced borrowing costs on mortgages, indeed that line has turned the other way again. And you can see this sort of like spike up again in residential mortgage credit from the first quarter of 2019 to now. So that's going the wrong way again. We don't want people to add more debt in this environment. And so the Bank of Canada, for now they say they're going to monitor the evolution of financial vulnerabilities related to the household sector and, hold pat and hope for the best. And frankly, that's about all they can do because we've had this extremely, lax lending policies for over a decade because of the situation we're now in. We're kind of painted into a corner here. And the best way out is going to have to be purpose-driven tax revenue increases, the issuance of specific bonds for specific purposes, and that will not be a quick, fix or jolt to asset prices, but rather a way to reinvest in longer-term concepts that will actually reinvigorate the economy over time. So this will be a positive development, but it's going to be painful in the short run in terms of earnings compression, in terms of profits declining, and that's what we are already seeing.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, funding crunch in short-term lending. What kind of alarm bells does that raise?
So that's something we've been watching now for the past couple of months. So if you remember last December when the markets really went into a downturn, about after the first week of December, they really sold off with a big crescendo into Christmas Eve. And there was a lot of dislocations happening all of a sudden, and it took many people by surprise. Well, there was a build-up to that in many things, extreme valuations, speculation, all the usual suspects. But on the other hand, the other factor was a spike in overnight lending rates. So this is part of the daily market clearing function of banks lending to each other, of dealers needing, short-term cash, and there's this whole system. It's called the repurchase agreement market or the repo market. So in the U.S., this is a massive market, and it's about $1 trillion a day turns over. And it is essential that it's to be the most liquid, cheapest funds available, right? So what's happened in the past couple of months, we noticed it in about September 17th. This overnight rate, which is typically pretty moribund, about 2%, all of a sudden spiked to 10%. And so the New York's Federal Reserve started funneling money into the system, which is sort of typical for them to do that. But it was alarming that overnight it went so quickly. And what that really meant was that banks weren't lending to each other for some reason. They would rather leave money on deposit with the Federal Reserve, or, safe deposit, so to speak, earning 1.55%, then lend to each other at higher rates or lend to other dealers at higher rates for their short-term liquidity. So it really was a kind of a red flag because, so they intervened and punched a bunch of money in, and they said, well, it was just short-term funding at the end of the quarter because corporations were having to make corporate tax installments, and, there was a lot of treasuries being sold because the U.S. government's running a big deficit at the moment, and so they're doing a lot of funding raising and selling of treasuries. So there was all these reasons explaining why they said that this spike had happened. But the problem is in the 2 months since it has continued, and the New York Fed has now pumped in something like $320 billion. There's a chart that I put on the blog just to December 2nd. And so the question is, this on top of the $60 billion a month that the Fed is now back doing in terms of quantitative easing, in terms of bond buying. They continue to do that. Their balance sheet, which had turned down for several months, is now on its way back up to $4 trillion again. Again, here they are. They're back in cutting rate mode. They have very little room on the downside to work with. You've got some of the Federal Reserve members saying they want to cap rates, which is their way of saying, let's agree now that we can't go below a certain threshold. So let's cap rate, if we're when we have to cut rates again, let's say we can't go below 0.25 as an example, which is the lowest they went the last time. So there's this, there's a lot of political pressure right now. Certainly President Trump is constantly, saying that the Fed isn't doing enough to stimulate. Meanwhile, they're doing these extraordinary measures of intervention both in the T-bill market overnight and as well in the bond market where they're buying these assets off banks on a monthly basis, all to add liquidity to the system, and yet the system is showing that it is short on liquidity, that it's having funding crunch. And that is the sign of trouble or concern because, when you don't have, another perfect example of this is that, the preferred share market, as an example, so preferred shares are a type of equity that companies issue, and they are given preferential credit protection versus common shares, but less than bonds. Many people have been treating these things as if they're fixed income, bonds, guaranteed deposits, but in fact they're not. They're equity. And in Canada, it has become so crazy that in the past couple of years, many or some firms have started to take cash where they would, like what you need for short-term cash needs, and actually put it into things like preferred shares. Well, what's happened to these things in the last year? They're not cash, they're equity. They shouldn't be used as cash. It's just because people wanted to pick up extra yield because cash was paying so low. And so what they've done is they put the things they need intense liquidity into something that is inherently illiquid. And these instruments have fallen in value a lot. So imagine if the cash portion, the money that you need to keep safe and liquid for daily or monthly needs, starts crashing in value. And that's essentially what is happening. It's been managed improperly, and it should never, people should never be putting short-term money in something with a long duration, and that's what they've been doing, seeking yield. It's the same thing that's happened in Canada with the bank shares. Seniors and people who can't afford to lose money have come out of GICs and guaranteed deposits, savings accounts, and put it into things like bank shares because they thought that they could earn a higher income there. But they haven't taken into fully account the extremely different risk profile, the capital risk, the fact that they can fall by half and more in value while you're trying to collect that income. So I'm afraid that everyone's going to be in for a new crash course, don't mind the pun, but in how to manage cash and in the difference between asset classes, things that are meant to be safe and liquid and things that are meant to be long-term investments. Right now, they've conflated it all, and that makes this system extremely fragile and dangerous.
Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.